Hi, I'm Courtney Lesniak with the Lesniak Group. I'm here with Alex McKenna, and we're going to go over conventional mortgages. So Alex, can you tell us about a conventional mortgage?
So the conventional mortgage program is going to be the very bread and butter mortgage program. It also goes by the names conforming, qualifying, as it conforms to and qualifies for the standards set by Fannie Mae and Freddie Mac. There's a common misconception around the conventional loan program where you have to put 20% down. Now that is just not true. There's probably some confusion there with people knowing that private mortgage insurance falls off when you reach 22% equity in the home, and this loan program tends to be for people with higher credit scores.
So what are the minimum requirements for a conventional loan?
The minimum requirements for a conventional mortgage loan are going to be a credit score of 620. Usually a conventional mortgage becomes a more viable option around a credit score of around 700, just because interest rates get lower and mortgage insurance rates get a little bit cheaper. As far as down payment goes, Fannie Mae has a fantastic program called Home Ready where you can put 3% down and still qualify for a conventional loan. So that's going to be a fantastic program to kind of keep in the back of your head. If you don't qualify for Fannie Mae's Home Ready program, because it is a little difficult to qualify for, you can put 5% down if you've bought a home before, or 3% down if you're a first-time home buyer. So those are going to be the minimum requirements to qualify for a conventional mortgage.
So how would somebody go about qualifying? What documents do they need?
So to start, you're definitely going to want to call your local lender. We here at Cross Country Mortgage are in all 50 states. So if you reach out to me, I'll definitely be able to connect you with somebody who's local to you. As far as documents go, you're going to want 30 days of your most recent pay stubs. You're going to want 2 months of bank statements, a picture of your license, and then, if you're paid W-2 or 1099, 2 years of your most recent W-2s or 1099s. And then if you're self-employed, of course, 2 years of your most recent tax returns.
So how much home can somebody qualify for?
Sure. So that is a complicated question that involves us getting into debt-to-income ratios. Now, a lot of people have heard the term debt-to-income ratio before, so I'm going to try to shed some light on what they are and how they're calculated. So there are two kinds of debt-to-income ratios. The first is the front end, and that takes a look at the proposed monthly payment, including mortgage insurance, property taxes, homeowners insurance, and divides that by your gross monthly income. So that's going to be proposed mortgage payment divided by gross monthly income. Now, the back end is going to take a look at the proposed mortgage payment plus any kind of monthly debt obligations you might have. Things like student loans, auto loans, anything like that. It's going to take those two numbers, add them up, and divide that by your gross monthly income. So for a conventional mortgage, we're going to want to be looking around a front end debt to income ratio of about 40% and a back end of around 50%. Those tend to be the maximums in most situations.
Lots of information. So can you walk us through an example?
So let's say hypothetically we're going to talk about an applicant named Jim Smith. Now, Jim has a car loan that costs him about $500 per month. He makes $2,500 per month. He's a salaried employee. And he is looking to buy a house where the monthly mortgage payments are going to be about $1,000. Now, to get the front end ratio, we're going to take that $1,000 proposed mortgage payment and divide that by a salary of $2,500, and that's going to give us 40%. And then to find the back end, we're going to take the $1,000 proposed mortgage payment, add his $500 car loan, and then divide that by his $2,500 salary. And that is going to give us a back end ratio of 60%. So with ratios like a 40-60, Jim's not going to qualify for a conventional mortgage. So what we would be looking at doing for Jim is probably paying off some more of that auto loan, maybe looking to refinancing it, and just drop that monthly payment down a little bit, hopefully to get him around 40-50 ratios, and then he will definitely be able to qualify for a conventional mortgage, provided that he has the down payment money and everything like that.
So I know conventional mortgage have a debt to income ratio that you need to qualify for. Is there anything else that we should know about qualifying?
So the great thing about conventional mortgages is they have some flexibility around other parts of the application. There are other loan programs that care very much about certain things. You know, FHA cares about delinquent federal debts. USDA cares a lot about recent late payments. But the great thing about a conventional mortgage is if you qualify, you qualify. There's no extra super strict hoops that you're going to need to jump through, and nothing, no one line item specifically is going to disqualify you.
So I'm sure there's some people out there who are thinking that they can't qualify because of bankruptcies. Can you tell us more about recent credit issues?
Definitely. So that is a conversation that I have to have with a lot of my borrowers. Conventional mortgages are not the most flexible when it comes to recent bankruptcies, foreclosures, or short sales. For bankruptcies, you're going to want to be about 4 years outside of a Chapter 7. You're going to want to be 2 years outside of a Chapter 13's discharge date, or 4 years from the dismissal date, whichever comes sooner. And then for a foreclosure, you're going to want to be about 7 years outside of, and then for a short sale is going to be 4 years. So there are definitely some longer terms for significant credit events in your past that we're going to have to wait out if you still want to get a conventional mortgage.
Thank you for watching, and check out part 2 of our conventional mortgage series.